Hello and welcome to part 3 of my series of valuations, and for this section I'm talking stocks and some ways to quickly value to buy, sell, or hold. My Finance in 5 intro video gave a quick overview on valuations, and now you want more knowledge because you're interested in finance and you want to become a successful investor. Well, hopefully you save and maybe invest in stocks. But what stocks are you going to buy? What style? How much? Why? When? When to sell? How do you know if you are a growth, value, or a momentum investor? Wow, that's a lot in a few minutes. Okay, let's go. I'm trying to educate in a brief overview. So for this video, we'll use 3 types of stocks, and those are going to be growth, value, and yield. Liquidity is equally important to everything, so let's just leave this as a forever category in all our investing decisions. For liquidity, almost all trades financial are expressed based on a size and daily volume. So if you have low daily volume of trading, well, this is known as thinly traded position. These stocks or equities or bonds will often have a higher spread between the bid and the ask price, which can affect your profitability when you go to sell, along with higher volatility when good or bad news occurs. Now, the spread is the difference between the two sets of numbers. Financial jargon. It's the maximum price you're willing to buy something for, aka the bid price, and the ask price represents the minimum a seller is willing to take on a trade. Now, I've been a portfolio manager for over 25 years, and I've witnessed multiple instances of panics and market liquidity problems. But in my personal experience, the market will act rationally 99% of the time. So normal liquidity is based on average daily volume. Higher numbers are better, as it means more people are willing for buying and selling, which lowers the spread of the bid and the ask for quicker transactions as well, at the price that was recently quoted, that would be. Value stocks are often associated with Warren Buffett from Berkshire Hathaway, but his partner, Charlie Munger, is equally brilliant, and both are students of Ben Graham and David Dodd, who were teachers at Columbia University and authorized this book called Securities Analysis. A great biography I would recommend by Warren Buffett is Snowfall, Warren Buffett and the Business of Life. It's good in life lessons as it is financial. I highly recommend it. And both book links will be in the Show More section. To simplify the classic approach to identifying value, it's to buy a company that's not being appreciated even though all the public information is available. And value buyers, they're looking for bargains today with potential to be long-term consistent growers. Better yet is when these value investments throw off free cash flow and increase their equity value. They go up in value. For example, Berkshire Hathaway, they bought See's Candies, and they paid $25 million for that in 1972. And today, that company has given Berkshire Hathaway well over $2 billion in income. That's a return of more than 8,000% or 160% per year. I got these stats and some more information by a great article by Zachary Crockett. Little shout out, give him a link later. Now, deep value buyers are not chasing hunches with speculation of hitting some big gains. In the above example, Berkshire paid a premium for See's Candies compared to all the other prior deals because they pivoted and started to focus on finding the best companies, not just the best deals. It's better to own a great business at a good price than a good business at a great price. And sometimes the value is on the potential for the brand, which is like an tangible valuation. For book analysis forms of value investing, you really need to understand how to read a company's balance sheet because you're buying a business mentality and not some short-term training, but long-term ownership. What I've done is create a free custom Yahoo profile for some of the columns I would use when trying to quickly filter for a value stock. I will create and place a link below, and I'm not being paid by Yahoo for this. And those in categories that I put in those columns, book value, trailing and forward PE, price earnings, price to book, forward yield, PEG ratio, 52-week low, change percentage-wise, and 52-week high and low. Once I find something that interests me and gets past that initial filter, whatever it might look like, I'll dig a little deeper. and I'm looking for clues to tell their story. For example, how does one stock compare to other in the same industry? So if you're UPS and you're FedEx, well, their multiples for all those things I just talked about in the columns, their multiples should be closer. And if not, why? And maybe once you find a bargain on paper via stats, then you need to explore why the stock is selling for that price. Were there past events that were affecting this company in a negative or a positive way? This digging for details is a type of fundamental analysis. Growth stocks, well, they're often associated with technology, with electrons, or anything new with a high growth rate. But growth, it comes in many forms, from food to fashion. For example, let's take Shake Shack burgers. They're opening stores rapidly, and they're growing at double digits each year. So you're not necessarily buying the stock for the stores they have today and the profits those stores are generating today, but if you were to investing on the premise that 20 years from now, the globe will be covered with Shake Shacks and you can get a burger, shake, and fries in minutes from anywhere. Well, kind of like the Golden Arches. And it's because of McDonald's, the consumer has many examples of deep wealth created over time by finding the growing food company to invest your money. Software and tech, well, they get all the love for the growth because they are often consumer facing. So then maybe it's software, gaming, it's Activision, or chips, Intel, or software, Microsoft, and Apple, et cetera, et cetera, et cetera. But companies behind the scenes have been growing to support those consumer businesses. And I'll give you some examples. The cell tower company that just beams out everybody's cell phone, Crown Castle, or a chip supplier like ARM, or a backbone for the internet company like Akamai. So how do we define growth? Well, in numbers that would be good or bad. With growth, valuations are much harder to assess. And I'll give you an example. That's because the level of speculation often associated with growth. Often investors are following momentum stocks into the land of growth while disregarding all valuations. If I were to single out one acronym for valuation on growth, it would be GARP, which is an excellent movie, and it's also an acronym for growth at a reasonable price. It's okay to pay a premium for something if it's growing higher. One stat for this is a PEG, or price to earnings growth ratio. Well, what you want to look for is a number under 1 for it to be considered attractive. But you truly need to dig deeper because earnings are often affected by a variety of one-time events and don't really tell the whole story. So a company can strategically write down an investment for, let's say, tax purposes, and this would be smart planning, but that'll affect their earnings. One type of investor, well, let's call them a hybrid. They're looking for growth stocks that have fallen in price for some reason and now are a bargain price. They are nicknamed fallen angels. It's a style I've followed for quite some time. Here are some examples. Lululemon was growing at double digits when they had a manufacturing shear problem, and the stock quickly tanked 17.5%. And Chipotle, well, they had a well-publicized problem with food prep safety. Tesla, well, they had their CEO Twitter himself in the SEC purgatory. Their common story between all these companies is the brand loyalty and how management dealt with the problems. So let's talk about assessing these fallen angels. Are recent troubles bumps in the road, or are they big mountains? If these problems, if they're mountains, I suggest you find another way to invest. Did the vision change and their potential to earn new business or clients? If yes, find another way to invest. Well, even these rules can be broken, so don't take them as gospel. I'll give you an example. Recently, Slack was a total pivot from game development. If you believed in the team and the new vision, you made a lot of money as an investor, which I'm going to cover in private equity investing. Back to Twitter, they're another example of a fallen angel, and they are more popular today than ever. My advice for investing in growth stocks and valuations is to either love the company and just trust in their potential and disregard anything for valuations. Just throw it away. These are called cult stocks. Or, secondarily, have a discipline in place for what you will buy and why, with secondary consideration for maybe long-term goals or short-term profits. There's another option for growth investing, and that is to follow momentum and have strong opinions on what signals to look for to exit your trade. In momentum, you're only in it for the ride of the tide, for or against a specific stock or bond. We're not going to cover shorting or other aggressive strategies in this video series. These are just the basics. To quickly calculate yield, I'm going to throw it over to my partner, Adam Myers, who's back in the office.
Thanks, Ian. One of the most powerful ways to make money in the market over the long term is through dividends. Over the last 4 decades or so, more than 2/3 of the market returns have come from dividends, not capital appreciation. So let's break down what that means. When any investment pays a dividend or interest, it's expressed as yield. The yield formula equals income divided by the stock price. So a $25 stock paying $1 a year in dividends would have a yield of 4%. When trying to value investment for yield, your priorities shift away from those of the growth or value investor. Liquidity is still of prime concern. But the next most important questions are those of predictability and stability of the declared dividends or interest. Consistency is prized above all else because a company's positive legacy says to investors they have a higher likelihood to maintain or increase those dividends. There's an entire style of investing for these dividend payers, and you can take a look at the ProShares, S&P 500, Dividend Aristocrats, Exchange Traded Fund, symbol NOBL. This is just one ETF that focuses exclusively on the S&P 500 Dividend Aristocrats, which are high-quality companies that have paid and have grown dividends for at least 25 consecutive years, with most doing so for more than 40 years. As an investor, make sure you consider dividends as part of your strategy. Quick and fast. Back to you, Ian.
Adam, that was an awesome job explaining yield and its importance. And what some investors might do is take that knowledge and look for stocks that yield more than the current U.S. 10-year Treasury. Yield stocks are highly correlated to interest rates, and here's why. In normal times, which is not what we have right now with the Fed 30-year at 1.2%, there's a spread that normally exists between the U.S. 10-year Treasury and almost every other interest-paying investment around the world. And that's because big country currencies and their stability is what creates these supportable low rates. In normal times, you would expect for certain stocks to be trading at a specific range, let's say 2 or 3% higher than a U.S. Treasury. But with this panic and uncertainty, there needs to be a higher yield than normal as investors are afraid to commit their capital. To determine a bargain and yield value, you should look for these points. Have they announced or anticipated a cut in dividends? Do they have a history of paying dividends, and do they sometimes suspend those dividends? Is the dividend sustainable based on the recent anticipated profits? And is their business steady, or is it in decline, or is it growing? How much are you getting for this investment versus other yield investments, and do you perceive this as less risky? Now, sometimes the current yield and historical past of company, they look great on paper, but they could be a value trap. I'm going to give you an example of what a value trap is. And that would be, let's say, newspaper companies. They once paid out high dividends because for decades they made high positive cash flow. But then the internet disrupted their business and dividends were reduced or went away. If you investigate the ETF for consistent dividend payers, you're going to see a theme of how these businesses often fill a need and how they cautiously allocate their new capital. Invest in yourself by helping us make more of these videos. Hit the like, subscribe, and notification button. It's the easiest return on investment we might ever get. I'm Ian Goldie. This has been Finance in 5 Extended Edition, Valuations for Stocks. I have 4 videos total in this valuation series. One video is our 5-minute intro, another for real estate, one for private loans and equity. Check them out and learn more. It's my fondest hope that I could help you become financially stronger, get you one step closer to turning your dreams into goals.